Today, I'm gonna try to dig into the world of monetary policy. What is it? Why does it matter? And who benefits from the way it's used? Let's unpack it all.
You are now relearning economics.
Think of the economy like a massive ship traveling through a narrow channel. On one side, you have high inflation. On the other, you have high unemployment. The government uses two main tools to keep the ship steady: fiscal policy and monetary policy. Fiscal policy involves the government spending and taxing. Monetary policy, on the other hand, focuses on managing the interest rates and the money supply. Monetary policy comes in two flavors: expansionary and contractionary. Expansionary policy is used when the economy is slowing down. By lowering interest rates or increasing the money supply, it encourages borrowing and spending. On the flip side, contractionary policy raises interest rates to cool down an overheating economy and curb inflation. It's all about striking the right balance. But monetary policy is more than just a technical tool. It's also a reflection of broader economic priorities. For example, central banks often aim to achieve price stability, which means keeping inflation under control. They also focus on maintaining full employment, though the emphasis on this goal can vary depending on the country and the economic context. But how effective is monetary policy at steering the economy? And what happens when its main tool is being used? Let's explore this in greater detail. Interest rates are the most well-known part of monetary policy. Central banks like the Federal Reserve in the US or the European Central Bank adjust interest rates to influence borrowing and spending. The idea is simple. When rates go up, borrowing becomes more expensive, so people and businesses spend less. When rates go down, borrowing is cheaper, encouraging spending and investment. But there's a catch. Interest rate changes don't affect everyone equally. For example, if you have a fixed rate mortgage, higher interest rates might not impact you right away. However, if you're planning to buy a house or take out a loan, rising rates can make things much harder. This creates winners and losers in the economy. Savers and bondholders tend to benefit from higher interest rates, as they earn more on their savings and investments. On the other hand, borrowers, including small businesses, renters, and homeowners, feel the pinch. This disparity raises some important questions. Is monetary policy fair? Timing's another critical factor. It takes months, sometimes even years, for changes in the interest rates to ripple through the economy. This lag can make monetary policy a tricky tool to use efficiently. For instance, by the time higher interest rates curb inflation, they may also have slowed down economic growth more than intended, leading to job losses and financial strain for many households. Moreover, the effectiveness of interest rate adjustments depends on the broader economic environment. In high-debt economies, for example, even a small increase in the interest rate can have outsized effects, as borrowers struggle to meet their repayment obligations. Conversely, in an economy where debt levels are low, the impact might be less than pronounced. Inflation, or the rise in prices over time, is often blamed on excessive government spending or money printing. But is this the whole story? Not quite. Inflation can also be caused by supply shocks, like a pandemic, messing up supply chains, or even corporate pricing strategies. For example, when oil prices spike, transportation and production costs rise, affecting the prices of almost everything. Also, companies might raise prices simply because they can, a practice known as price gouging. This was evident during the pandemic when shortages of essential goods led to significant price hikes. Another cause for inflation is changes in demand. When consumer spending surges, businesses may struggle to keep up with demand, leading to higher prices. This is often referred to as demand pull inflation. On the other hand, when production costs increase due to higher wages or material costs, businesses pass those costs on to consumers, resulting in cost push inflation. Central banks tend to treat all inflation the same way, by raising interest rates. But this approach doesn't address every type of inflation effectively. For example, raising interest rates won't fix a supply chain disruption or reduce corporate price gouging. In fact, using interest rates to fight inflation can sometimes cause more harm than good, like triggering recessions or increasing unemployment. To understand why monetary policy dominates today, we need to look back at history. In the 19th century, there were no central banks or monetary tools for that fact. Economies were highly volatile, with frequent booms and busts. It wasn't until the creation of central banks and policies like the New Deal in the 20th century that we started seeing more stability. Interestingly, while we complain about inflation today, the pre-central bank era was far worse. Deflation or falling prices was common, and it caused widespread bankruptcies and instability. This was because deflation increases the real value of debt, making it harder for borrowers to repay their loans. Take the Great Depression, for example. It was a period of massive economic hardship, and it showed the limitations of relying solely on market forces to stabilize the economy. This led to the rise of Keynesian economics, which emphasized the role of government spending and intervention. Keynesian policies played a crucial role in pulling economies out of the Depression and laid the groundwork for post-war prosperity. However, the dominance of Keynesian economics was challenged in the 1970s when stagflation happened, a combination of high inflation and high unemployment. It shook the confidence in government-led economic management. This paved the way for the resurgence of the neoclassical economics, which prioritized controlling inflation through monetary policy. The problem is that monetary policy has its limits. Adjusting interest rates is like using a blunt tool to fix a delicate machine. It works, but not perfectly. Fiscal policy, on the other hand, can be much more effective. Government spending on things like infrastructure, social programs, puts money directly in people's hands, boosting the economy faster than interest rates adjustments can. Yet, fiscal policy is often sidelined due to political gridlock. It's easier for central banks to act independently, even if their tools aren't always the best for the job. This reliance on monetary policy alone can lead to imbalances, as it often fails to address the structural issues like income inequality or underinvestment in critical sectors. One innovative idea is to combine fiscal and monetary policy more closely. For instance, central banks could work directly with governments to fund public projects. This approach, known as MMT, challenges the traditional ideas about debt and spending. By coordinating fiscal and monetary efforts, policymakers could tackle complex challenges more efficiently, from climate change or technology innovation. What does the future hold for monetary policy? One idea gaining traction is the use of Central Bank Digital Currencies, or CBDCs. This could revolutionize how money flows through the economy, making monetary policy more precise and effective. For example, a CBDC could allow central banks to deposit money directly into a citizen's digital wallet during economic downturns. Another idea is to rethink the role of central banks altogether. Instead of focusing solely on interest rates, they could play a more active role in managing public investments and addressing long-term challenges like climate change and inequality. For example, central banks could support green investments by offering favorable financing terms for environmentally friendly projects. Ultimately, the goal should be to create a more stable and equitable economy, but to do that, we need to rethink how we use the tools at our disposal and who benefits from them. The future of monetary policy isn't just about numbers and charts, it's about building a better world for everyone. If you found this kinda helpful or insightful, don't forget to hit the like button, share the videos. It makes economics more accessible. Let me know in the comments, what do you think is the best way to manage the economy? Until next time, take care.
You are now relearning economics.